So I first wanted to start out with kind of the influencers of our market, of this biofuels market. And of course, the number one influencer is the Renewable Fuel Standard, the RFS, the RINs. And what I wanted to do is kind of just provide a little color, literally some color, as you'll see here in a second. It is my psychedelic nested RVO that we have here. So RVO, we're going to have a ton of acronyms because that's what we do, right? So the RVO is a renewable fuel volume obligation. This is an obligation that the EPA sets every year. We actually know what 2024 and what 2025, what those obligations are. And as all the different players of the renewable fuel standard, there's the renewable fuel producer, there's the obligated party, and there's the biofuel blenders, which is what are you guys? So the renewable fuel volume obligation is something that is set by the EPA, and it's basically thinking about what is the total volume of renewable fuels, biofuels that obligated parties, which can be refiners, importers, what they have to commit to for compliance each year. So we're kind of back on the regularly scheduled programming as well for EPA compliance. So for 2024, that compliance is due by the end of March next year for 2025. We know what those obligations are. What I wanted to show in this, my little egg here, the psychedelic egg, is that just kind of thinking about it, and I know that Xander and David will bring some more additional color to this, probably in a different way. But I just wanted to show that how this works is that I'll call these buckets. There's 4 different buckets. And for the obligation, there's 2 buckets, the cellulosic biofuels, the D3s, and the biodiesel, biomass-based diesel, D4s, are kind of their own buckets, their own special buckets that they can only be satisfied with those types of RINs. These other 2 circles, the purple and the yellow, the larger circles. So advanced biofuels can be satisfied with D3, D4, or D5. And then the total renewable fuels is all of them. So they're very different on how you can comply. And some obligated parties are going to look at this as whichever D code, whichever RIN is the least expensive is how they're going to make this compliance work. And the other little note that I wanted to put in here is that just a reminder that the obligated parties have a 80-20, how they can meet their compliance obligation. So come next March for their 2024 obligation, they can use 20% of their obligation can be 2023 RINs and 80% can be the 2024. Or they could, this is just an option, they could just do all 2024s. So the RFS is obviously a big influencer of the market and what's going on. And the LCFS is another one, a low carbon fuel standard. So when we think about this, we think about West Coast only, but really I'm sure many of you have experienced, you know, if you have somebody producing fuel in your backyard, it actually might be getting shipped and out by train to the West Coast because they can take advantage of the LCFS credit as well as the RINs. So that obviously does affect our market. Even if you're in the middle of Iowa or if you're in Illinois, that affects your market and where your supply is coming from. So the other couple other things I wanted to touch on were, you know, looking into state incentives. You know, we're going to talk a little bit about, or a lot about the biodiesel, the blender's tax credit, but there's also state incentives too that I'm sure many of you are already aware. But if there's some other states that you're thinking about starting to operate in, or maybe not, or just getting started, there's some of resources you can look into. The Alternative Data Fuel Center has actually a lookup table that you can look up your state. You can filter by your state and see what sort of state incentives may be available for biofuel blending. We also have a link on our site too. The Alternative Fuels Council website also has a link to that. So you can actually filter down to your state that you're looking into to see what the incentives are. Uh, I also wanted to bring up the federal loans that are available, particularly the USDA-backed HBIP, as we lovingly call it, some more acronyms. So that stands for Higher Blends Infrastructure Incentive Program. Some of you may have already taken advantage of this. And if you haven't and are interested, we can definitely hook you up with Jeff Carpenter over at USDA, and we can get you some more details. And we have some more details on our website as well that can provide a little bit more. So talking about those loans, I just wonder and thinking about the future, and I don't know if Xander or David want to jump in on some of this, but just thinking about, the future, and, I don't know what's going to happen with the blender's tax credit for sure, but just thinking about the RIN market, the tax credit, what's going on with supply. A lot of my clients are having a hard time finding supply sometimes if a plant's shut down that they were relying on. And I'm thinking about some of these loans or some of these incentives that may help to think about maybe some different ways of doing business or doing some blending a little differently, like putting in a new tank to provide more storage for biodiesel, or getting supply a little bit different way. Is there some sort of way you could get access to rail? Is there a way you could start transloading? That's some of the federal loans. This HBIP does provide some funding towards transloading, or maybe there's a group of you in the region that might be able to, pool together and figure out a way to try to get more supply to blend more fuels, just to take advantage of more of these incentives. So I don't know if, and some other equipment too, some inline blending equipment, that can think about, and I'm really focused in on transportation, but really a lot of this applies to heating oil too. I don't know if we have any heating oil folks on the call, but so this is not just transportation, this is heating oil for a lot of what we're talking about, including the HBIP loans. So I didn't go too much into the biodiesel tax credit because I want David to dive into that. And so David, we were talking about how we've been in this kind of environment before where we don't know what's going to happen to the blender's tax credit. We've gone back and forth, the retroactive. But now we're in a little bit different situation. We kind of got this other tax credit guy in the background that might be coming forward, and how could this make things more complicated, or what are kind of the different scenarios we should be looking at?
Sure. That was helpful background, Ginger. Thank you again for having me here. I think, at the end, a little segue there, the point that you were making big picture about the opportunities for investment here, it's easy to kind of get lost in near-term thinking, and most of what I guess the rest of the conversation will be around here in terms of policy prognosis is really kind of a 1 to 3 to 4 year conversation. It's hard to really anticipate how these policies will develop with granularity much beyond that kind of arc of time. But I think were you to kind of take a step back and look bigger picture, particularly as more EV news gets kind of bearish, and we're still going to be looking to decarbonize transportation fuel, it's not unreasonable to be bullish biofuels big picture, even if you don't know quite how the fuel will be incentivized, right? I don't think that there's a high degree of likelihood that biofuel incentives will be abandoned. And I think it would be a mistake to interpret a lot of the uncertainty that Xander and I are going to talk about today as being kind of inviting a bearish long-term sentiment about whether it's worth pursuing things like these grant programs that can, if nothing else, provide additional liquid fuel infrastructure that's going to be useful assets for the medium to long term. So anyway, it's good to be here. Do we have slides? Did I put together 2 for this?
Yep.
Good. Well, I'm going to start with this one. 2 kind of mechanisms by which the federal government incentivizes biofuels, not including the infrastructure, right? Ginger talked about the HBIP program to underwrite infrastructure. but the federal government incentivizes the actual biofuel as well, which is incidentally a quick sidebar. It's notable that that's something missing in a lot of the EV charging incentives, right? Where they have a tax credit for installing a charger and they have a grant program for installing a charger, but they don't have any kind of ongoing mechanisms to incentivize the acquisition of the energy and the selling of the energy, which is why a big reason why the EV charging market hasn't, taken off quite as robustly as biofuels did once we incentivized things like ethanol and biodiesel blending through both the RFS and the tax code. But anyway, the RFS element of the federal incentive scheme is what this slide is about, and we are in kind of year, I guess, year 2 of 3 for the new era of the RFS, where they EPA comes up with RVOs, annual blending mandates for multiple years. So they have a mandate in place now through 2025. And what we're experiencing is that the mandate that they came up with was lower than what the market was already intending to produce with respect to advanced biofuel, right? A lot of renewable diesel production was coming online, and EPA didn't incentivize growth in that category at a level that was commensurate with the increase in demand. So you basically have a situation where more RINs are being generated at a clip that exceeds the pace at which the mandate is growing, which is why RINs have, had such a wet blanket over them for the last year and a half, and have been dipping. The problem with a multi-year RVO is that there's nothing you can do about it now for 4 years, right? It's somewhat a little bit bad luck. You remember when they came out with the set rule. Ginger, you may know precisely, but I think it was like a month or two after the war in Ukraine started, right? So the gas prices were top of mind. Food inflation was top of mind, commodity supply chain problems, right? So it was really just kind of bad luck and the worst possible moment in time politically for this multi-year RVO to have come out, when there was such sensitivity to, food versus fuel trade-offs that may not have been top of mind at other parts of the year. But that's what this chart is the explanation for why RINs have been going down so much. Basically, there's more product coming in than is incentivized. And a major unknown that we can talk with Xander about later is, how will EPA incentivize the mandate beyond 2025? That final decision will probably be made not by the current president, but by whomever wins in November, right? This decision will not be made until after January 20th, 2025, I wouldn't think. So again, it's a little bit futile to get too much into game theorying out how that will work. But I do think it's safe to assume that the Biden administration has learned and digested the lessons from their coming up a little bit too short here, and will probably trend toward being more ambitious heading into a new set rule. Whereas I think a Trump administration, if passed as prologue, would come in and probably look for ways to continue this downward trend on RIN prices. And they could do that through a number of ways, both in lowering the RVO or those kind of ancillary, more nefarious methods through small refinery exemptions or something else like that. Xander, do you have anything you want to, I mean, I'm happy to talk about the tax code now, but I don't know if you've been just sitting there quietly, and I'm sure you have things to say, right?
Yeah, I'm a talker, so of course I have to interject here. No, I just to help paint the picture for folks on the set rule is that like uh, clearly you can see here the clear oversupply and primarily coming from the D4 credit from renewable diesel. But to speak for the EPA's intent here when they set the set rule, they were really focused on potential feedstock limitations. I think that's really where they got hung up on, and a lot of those didn't play out. I mean, feedstock is, these renewable feedstocks like use cooking oil, tallow, soybean oil, canola, distilled corn oil. They really thought that was going to be more of a bottleneck than it ended up being. And that industry really came through and kind of revolutionized in the last 2.5 years its ability to supply feedstock. And a lot of that came through the form of imports. And I would say second to that was they did want to be a little conservative, and they obviously overshot, but with an eye toward adding some RINs to the RIN bank, which was pretty depleted at that point. Um, and to have normally we were oversupplied on D6 and in that would show up in the RIN bank, but here you have a RIN with more utility to it and being an advanced or a D4 credit. So that's just some background on how we ended up here from the EPA standpoint.
Yeah, you're defending the EPA more than I would. I mean, I think the feedstock limitations were conservative because I think that reflected the moment in time where they were inclined to be conservative, right? Simply because of the uncertainty around what was going on in
Yeah,
Ukraine, right?
well, I mean, well, I'm not necessarily coming to the defense of the EPA. I'm just kind of giving the background or
Yeah, yeah.
on their intent. But no, I think it's tough to, the renewable diesel industry in 22, 23 was really undergoing revolutionary pace of growth. And it's really tough to set a 3-year target for something like that when the pace of growth is so fast. And as we've seen, we've slammed into oversupply and resulting margin compression. So, the news today from Vertex that we can get into later, perhaps, that, we got a renewable diesel producer a year into the game is going to switch back to producing conventional petroleum diesel, just announced on the earnings call today. So, it's a very, sink or swim environment right now. The margins have been compressed a lot. I think, I don't want to get the cart ahead of the horse here, but it's a lot to talk about today.
Yeah, so this is kind of like one element of uncertainty, right? How will policy result, what will this chart look like in 26, 27, 28? Will it right size or will it not? And that's kind of one set of decisions made by one set of decision makers, right? These are people at EPA who understand fuel markets pretty well and are going to be cognizant of how the market will likely react to one approach or another, which is an interesting segue now, Ginger, to the Treasury slide, because the other half of kind of fuel policy is governed by a group of folks at the Department of Treasury who, no fault of their own, they just lean more on like the tax nerd side than the intricacies of the fuel market side, which necessitates a different kind of conversation with them than you're able to really have with folks at EPA. Just kind of be mindful of that. So let's just kind of present the kind of if Congress does nothing, which is like not a crazy base case, what will happen? We will shift at the end of this year from what we have known and loved, which is a $1 a gallon technology specific credit for biodiesel, 50 cent a gallon credit for CNG, right? Tech specific, homogeneous kind of fungible commodity coming out of the production facility. Beginning in 2025, that will shift. It will no longer be a blender credit. It will be a production credit, which means, just like reading between the lines there, that means that fuel that is now imported and still able to access the value of that credit via domestic blending will no longer be eligible because only domestic producers are eligible. The flip side of that is that today, fuel that is produced here but exported is ineligible for that value because only domestic blending is eligible. Whereas once this credit shifts, then fuel could be produced here and then exported and still get that value, right? So different trade flow incentives associated with all of this. And a different overall amount of tax incentive flowing to it, right? So unlike today, where you get $1 a gallon, starting in 2025, the tax credit will be on a continuum of anywhere between 20 cents and $1. Most likely, we're looking at something between 40 and 60 cents. And the value will depend upon the specific environmental attributes of each gallon of fuel that's produced. So if Ginger and I have two different ethanol facilities, or that's another thing too, right? It's not just biodiesel and renewable diesel, it's now ethanol also going to be eligible for this tax incentive. But if there are two facilities, two production facilities, each making ethanol or each making biodiesel, but one of them runs on, coal-fired electricity, whereas the other one relies on renewable electricity, solar panels, what have you, then the renewable plant will produce a gallon of ethanol that would generate a higher tax credit than the plant that runs on coal, even though they're ultimately producing the same product, right? So you're dehomogenizing what is today a fungible commodities market, which presents a couple of questions, right? One, and I would be curious for Xander's thoughts on this, and then you can obviously feel free to take it in any direction you want. But one, I would wonder what effect it would have on RIN markets if the value of the credit is moving down from $1 to something less than $1, right? On paper, you would think that would have an opposite reaction in the RIN market, providing a little bit of a tailwind toward RINs, but that may depend upon how much product keeps coming in above what the RVO is. Curious for your thoughts on that. And then also just price discovery implications, right? It is very important, to say the least, that as buyers of this fuel, we have visibility into the value of the tax credit that the producer is able to get for producing it, right? If we're buying ethanol from Poet, and Poet has an 80-cent credit, we should know that and embed that into the price we pay for the fuel there. Whereas if we're buying fuel from a plant that has a much lower credit, we should know that too. That's how you ensure that the consumer can access this value if it's shared throughout the value chain. But unclear to me how the mechanics of that will work, because the people at Treasury, who again don't know this industry very well, are now charged with implementing what has the potential to be an extraordinarily complicated scheme here.
Don't you feel like this is almost very similar to how LCFS works a little bit? Like using all these different parameters to we're not creating a carbon intensity, but kind of, right? We're creating this tax credit that is based upon all those inputs like we do for LCFS. It seems very similar to me. And as being on the compliance end of this, I do wonder, how are they going to verify this? Is it going to be like LCFS or our QAP program through RFS? It'll be interesting to see what happens.
Yeah, no, I totally agree with you. I think the LCA structurally, I mean, we haven't talked about the SAF credit yet, which we should kind of segue to. And once we get into that, Tiffany, we'll probably kick it to you. But I would distinguish this a little bit from the LCFS, simply because I think LCFS tends to be structured in a way where the value of the credit is shared throughout the value chain to a degree that I'm not confident yet that this production credit would be, right? I almost think of it the way you think of the first 5% of biodiesel blended into ULSD, right? Which, you can put B5 in a pipeline and you don't have to label it, it's basically treated the same as ULSD, and it's never reflected in any kind of discount. And that's simply because the entity doing that initial blending before it goes into the pipe is retaining that value and then pricing the finished product at parity with ULSD. So I don't know if that made a ton of sense, but that's how I fear the tax credit could result in, where biofuels will still be priced the same, basically at parity with gasoline or diesel, and all of the value of the tax credit will simply be retained by the producer. And that to me is an incoherent outcome as consumers of fuel.
What do you think, Xander?
I mean, well, to start with, I think it's just as a general way to think about it, I think it's kind of fair to say that it's the producer tax credit, the 45Z is going to kind of act like a nationwide LCFS in that it's tied to CI score for the first time. It's backed by the same model, GREET. It's just not California adjusted, not the Cali GREET model. But you know, what's interesting is there's a max credit value. So there's a point where you're no longer getting rewarded for further CI reductions. And so in that respect, it's not going to be climately as aggressive as a Cali LCFS or an Oregon or so forth. But to David's question, the effect on the RIN market, I mean, all else equal, you would have to assume that, you know, you're losing the dollar credit. A lot of people that were getting a dollar overnight are going to suddenly get 40 to 50 cents, something like that. Some fuels, you know, some biodiesels from soy won't qualify for certain stuff, or canola. And a lot of these guys at this stage in the game haven't done a lot of their homework or sharpened their pencils in this area. So, I mean, we're only a couple months away here. But from talking with people in the market, you know, kind of pulling the market, getting an idea for what other people are thinking about this, they actually think that feedstock markets are going to react first. So suddenly you have a producer wakes up, I'm getting 50, 60 cents less. I'm going to obviously trim rates, buy less feedstock. Feedstock prices crash. Well, not a crash, say, but let feedstock prices come down. And so the RINs will probably be like kind of frozen in that environment. They're going to be like on the back of their feet there, and it's going to be tough to react to that. So either way, you know, CBOT soybean oil, very liquid, RINs extremely liquid. They're both going to be quick to react. I think it's a chicken and egg thing. I could see the feedstock getting hammered there a little bit in the initial stages, but all else equal, should be bullish for the RIN. Particularly as it's not going to incentivize as much production per se. Second of all, in terms of like price discovery implications, what I'm kind of worried about when you get something like this, where it's everything CI dependent, is you're gonna have a lack of fungibility per se. Like if you have, let's say you only have two suppliers of renewable fuels at your rack or wherever you're blending, and one's got a great CI score, the other one doesn't have such a good CI score. They're passing through a lot of extra credit value. You know, if you're able to buy the cheaper stuff that's more subsidized, that's great. But if they don't have production that day, your blended fuel, like your renewable fuel portion, could cost a lot more. And you can see a lot of variance there. So do we see that play out in the Cali system? Not necessarily. I mean, what you see is people trading you know, when they trade ethanol, it's kind of like, this is in the 79 range. You know, there's some CI giveaway. So I think markets will adjust that way, because it's the fungibility is going to be kind of a nightmare for market participants.
And we don't know, like, maybe they've said this. I don't think they have, but I don't think we have clear guidance as to whether the credit ranges will be like, will it go from 20 to 40 to 80? Like, are there going to be big bands like that, almost like with the RFS, or will it be far more incremental? Because I think that could also impact fungibility too, right?
It's incremental, unless, I mean, I think the big component that it hinges on are the prevailing wage and apprenticeship, which is
Right.
pretty interesting, because everyone in their credit assumptions that I've seen is building it in like they're going to get the full value, not the base credit. And there's a tremendous, you know, it's multiplied by 5, so there's a tremendous difference there. So you got to make sure to do your due diligence and ensure that you're meeting your labor requirements, and your apprenticeships requirements to get that credit, because that's really what holds it in place.
So this so far, I think, has been more like, this is the if Congress does nothing conversation. It's worth talking quickly about what is not unlikely to happen. But you know, there are Republicans on Capitol Hill, and Democrats for that matter, who do not view the blender's credit as needing to go away during this transition to a producer credit. particularly in light of the uncertainty around how the producer credit will be implemented. So it's not unreasonable to imagine at the end of this year in a lame duck session, or even next year in a retroactive posture, Congress looks at extending the biodiesel blenders credit just like they have in the past, right? That credit can coexist with a producer credit. It wouldn't be the first time that type of scenario has happened within a value chain, and they would need to include some type of mechanism to make sure that the same taxpayer isn't double counting for the same gallon of fuel and whatnot. But that's certainly plausible, and I think a lot of folks, including producers in the coming months, are going to be advocating for that, right? We will not know how that will land until I would say Q4 at the earliest. So in some ways, this is not new territory, right? We've all kind of, if you've been in the biodiesel business for the last decade, you've gone through those machinations where the credit will be on the verge of expiring and then sometimes expire and get extended retroactively. We've kind of lived through every different playbook, so it's not new in that respect. The only new element is the additional layer of complexity by the fact that in the absence of congressional action, we will have this producer credit there, um, which just will implicate how people think about it at the end of the year. It's a little bit less dire. But nevertheless, that's kind of the main additional layer of complexity here. So, right, if you go to the previous slide, we had complexity around the future trajectory of RIN markets. And then there's uncertainty here around the future trajectory and value of at a macro level of how much tax incentive money is flowing toward this space. And then at a more granular level, at where exactly in the value chain the incidence of that tax incentive will be realized most directly.
Sander, are you ready to, do you want to get the cliff notes on the disclaimer?
I just, I wanted to make sure that if anyone had a JD or if they dropped out during 1L like I did, they'd have some literature to read. Not necessary. We can move to the next one.
Okay.
So just a quick introduction, because I am familiar with the NATSO crowd and Alternative Fuel Council folks, good friends of mine. But just a little bit about myself and my team here at AEGIS. So Sandra Capizola, I'm the Vice President of Renewable Fuels over at AEGIS Hedging. I run a research service for renewable fuels. So if you want to dork out or get highly educated real quickly on the RIN space, the SAF space, renewable diesel, regulatory updates, I can definitely help you out. And then we actually hedge some of these novel production. We're hedging SAF, we're hedging renewable diesel, we're helping out RNG producers. And I work with Scott Vitcher. He's really on the bro side or brokerage, and he's going to cover SOX, NOx, ERX, REX, REGI, Casper, every acronym and possible environmental credit. He can sling it and he'll get you a good deal. So we are happy to help you out and standing by. But let's dig into the nuts and bolts of this complex market. So I used the word revolutionary growth a couple of times already, and when you have revolutionary growth, it takes markets and kind of turns them on their heads. Creates a lot of volatility, which is fantastic for people in the advisory and consultant space because your phone is ringing nonstop, and you get to the point where you have to turn projects down. But at the same time, you also have the war in Ukraine has been mentioned. Massive supply disruptions, closure of the Panama Canal, Red Sea disruption issues, and so on and so forth. The point here is that the BOHO spread, or the spread between soybean oil and NYMEX ULSD, has classically been kind of a metric of the performance of the typical biodiesel producer. Somebody that's using 7.5 pounds of soybean oil and converting it into a gallon of biodiesel. So that would be the green line here. This is their profitability of for your standard U.S. biodiesel producer. And typically, if you went before the renewable diesel revolution, the correlation between just your D4 RIN, which is the dark navy blue here, correlation between the green line and that navy blue, just the D4 RIN alone, would be pretty close. And so you can see RIN markets have been extremely volatile as they try to catch up with the extremes of the conventional diesel market were mainly kicked off by the Ukraine conflict and the resulting disruptions, as well as a lack of global spare refining capacity. But at the same time, you had this revolutionary growth of renewable diesel to the point that it now makes up, biodiesel and renewable diesel combined make up about 7% of our diesel pool on a coast to coast basis. So if you see here, like starting in late March, early April, renewable diesel RINs, or the amount of RIN value that is created by a renewable diesel producer, is starting to correlate very nicely with the BOHO spread. And that shows some signs of finally a market normalizing. So the RIN is going to be much, much more responsive to the economics of a renewable diesel producer now versus, prior to 2010, where the RIN was extremely responsive to the economics of a biodiesel producer. And so this nice correlation here means that it's getting a lot easier to de-risk in this space. It also means that you can have a good idea for when RINs are relatively overpriced and when RINs are relatively underpriced. And certainty is a good thing in markets that, if you look at the left side of this graph, it's just a ton of volatility. So money can be made in the volatility, but a ton of money can also be lost in that kind of volatility. David, I know or Ginger as well, I know I covered a lot of that really quickly. There's some lofty concepts for some folks that might not be familiar with that. Do you think I covered anything too quickly there, or any questions on what I'm presenting?
I think that was fine for the audience, but do people have a mechanism to ask a question, Amy? Was that a thing?
Yeah, I see some questions come through here. Mainly SAF BTC and some 45Z questions, and we're going to cover those moving forward in the discussion. So but yeah, if you have any questions on this, reach out to me at AEGIS Hedging. You can find me on LinkedIn. I'm happy to take a call and walk people through this. And yeah, basically the point is that biodiesel used to be king. It's increasingly being supplanted by renewable diesel. So your D4 RIN, while it looks like the super volatile monster, it's actually really nicely correlated with your renewable diesel economics. And that's something I'm watching like a hawk all the time. And I think that's kind of the new normal here. I don't, kind of an overused phrase, but as we've seen, RINs in this BOHO spread are finally correlating from a renewable diesel's producer's perspective.
Tiffany, I'm so glad you joined us today. And Tiffany was going to share with us kind of some research that's been done and kind of NATSO's involvement in some of it. I don't know if you can share some of the recent research that has been going on with renewable diesel and biofuels.
Sure. Thank you. I'm Tiffany Wysłowski-Newman. I'm NATSO's Vice President of Public Affairs. As Ginger mentioned, there's a couple of pieces of new research that are out there that really buttress the argument that renewable diesel is really kind of the best option right now for reducing emissions from commercial trucks. The first piece of research was produced by Roland Berger on behalf of the Clean Freight Coalition. For those of you who maybe aren't familiar, the Clean Freight Coalition is a group of about 7 industry associations that really came together to educate lawmakers and regulators about the challenges with transitioning commercial trucking to electricity. Sorry, my light just went out. And that study came out and found that it's going to cost about $1 trillion to transition that industry. And it went through some of the current economic and operational constraints. But ultimately, it found that over-the-road trucking is ill-suited for electrification right now. They looked at what it would take to electrify the entire medium and heavy duty fleet, and they found that fleets and charge point operators will need to invest $620 billion into chargers and site infrastructure and utility service costs. And the truck stop industry, to build out what they felt would be a sufficiently dense charging network, would need to invest $57 billion. And then there was another $370 billion on distribution grid upgrades and to serve local charging demand. The American Transportation Research Institute then, just about a week or two ago, put out what I think of as kind of a companion piece of research that was really focused on renewable diesel and what they called as a catalyst for decarbonization. But ultimately, when they looked at electrifying the heavy fleet, they really came up with that same $1 trillion figure. It was a little bit higher, not quite 1.2 trillion. But that report very clearly determined that using renewable diesel to reduce emissions was going to far outweigh the use of battery electric. They found that relying on battery electric was going to cost nearly 6 times more than renewable diesel. And ATRI had completed another study a few years ago that found switching a truck from petroleum diesel to battery electric would decrease carbon emissions by 30%. And that same research found that using renewable diesel in an existing ICE truck would decrease trucking's carbon footprint by almost 70%. It was 67. So the difference there is really significant. And ultimately, one of the headwinds, since we're going to talk a little bit about SAF, and David mentioned that those feedstock concerns surrounding sustainable aviation fuel was kind of one headwind that was listed in there. But ultimately, it was determined that, limited feedstocks maybe some constraint, but that there is research that they're starting to look into, like algae and other feedstocks. So they felt that there will be 8 billion gallons of renewable diesel consumed by the end of the decade. Anyone who is not familiar with either of those research reports, I'm certainly happy to share them with you or answer any questions. Thank you.
Biofuel support. Don't stop lending. We didn't really talk much about renewable diesel supply. Typically, this is pretty much just seen on the West Coast, but I'm starting to hear more about it coming into the Midwest, or more availability in the Midwest and the Northeast. Xander, have you been kind of hearing the same thing? Is it kind of trickling in other areas because it's starting to get the storage saturation, and the West Coast is kind of coming to net capacity?
I mean, New York City and some municipalities have definitely set up some contracts to basically anchor themselves to using it. But really, the LCFS is really just a magnet for the fuel. I mean, California is getting the lion's share. We have seen Oregon take a good amount. I think their LCFS credits went from trading at $165 or more last year and just crashed down to like 70 and change in a very quick, rapid format. Some of that was from the import side as well. But yeah, it can now be shipped along the Colonial Pipeline, which means you can access the entire Eastern Seaboard with any kind of renewable diesel molecule. But right now, in my opinion, I mean, New York has taken a couple stabs at LCFS, gotten some serious sticker shock. And New Jersey, I think, would possibly, in my opinion, be the first East Coast state to flip. And then you could see certainly supply follow there. Obviously, New Mexico was the latest to join the low carbon fuel standard.
Right. There's a lot of states and different regions that are looking at this right now and trying to figure it out.
But I guess sorry, just to fully answer that question, I think if stuff was to leave the production center of the Gulf on a rail, it's more likely to bypass most of those markets and head to Canada right now, which is a huge blow-off valve for the RIN market, and something that we're monitoring as that could kind of help balance that RIN market a little bit more.
Aren't there different motivations for buying? It feels like there's the beginning, you read about the SEC came out with this emissions disclosure regime that people were afraid would include Scope 3 requirements. California has something similar where there's additional sunlight being placed by regulators and investors, shareholders around the environment, the emissions profile of companies. So if you're like a shipping company who is feeling that pressure, there could be a motivation to pay a premium for a fuel like RD. When you talk about, Xander's talking about all the fuel, the gravitational pull out west, right? That's in order to make the fuel price competitive, if not cheaper with diesel, right? That's what those incentives need. But if there's this kind of intangible value being placed upon cleaner fuel outside the general kind of incentive construct, that's a layer of additional gravitational pull that I think we are seeing in parts of the East where it wouldn't make commercial sense to buy RD rather than ULSD. Is that, I mean, I'm just kind of putting that together. Is that fair?
I would say that that's a perfect description of the SAF market because you have the airlines are all committed to buying SAF. They've made commitments with their large corporate partners. They've made public commitments on both an international and federal scale for climate commitments. But I would say, the thing with, like you said, to make it cost competitive, if renewable diesel lands at the East Coast, you have to pay at least California to clear it because you're basically have to attract away those molecules. So California really becomes the clearing price for renewable diesel in the United States.
Which
And
means
it's been like that for a while.
more. Is that what that means though? That if you're buying it outside of California, odds are you're not buying it in a place with as attractive an incentive profile as California has.
Exactly, not at all.
You're paying more for no
Exactly.
reason.
Yeah, exactly. I mean, like I said, that's really why, it's gained traction at like municipality levels,
Right.
That budget for it, people that are trying to go clean and green for their own specific reasons. But when it's people just move, when it's the market moving and talking, they're obviously, if you lose the 30 to 40 cents a gallon of LCFS, that would discount the blending, it's it's kind of a no-brainer to arb it into the appropriate markets. Now, biodiesel doesn't suffer as much from that, obviously, just because it's been around for so long, and it's just basically part and parcel of the supply chain at this point.
That's kind of one of the questions that came in is there a reason to believe that biodiesel economics will see a resurgence?
Do I have to tackle that one?
I'm happy to if you don't want to. I feel like you're more credible on the topic, but I'm happy to say what I know.
Gosh, I mean, if I had the crystal ball on that, I would have a yacht and be pretty fun, be having a fun time. But so much of this is tied to the economics of conventional diesel. And so I did a study recently. I put a small little report out. I have it on my LinkedIn. So diesel demand in the United States hit the lowest level in 25 years, the lowest level since 1999. And I was like, that just can't be true. Like the economy's you know, I would say there's a lot of recessionary signals that are flashing right now. I get it, but I was like, there's no way diesel demand is that poor. Now, for conventional diesel, it certainly is. But when you add in the renewables, which have penetrated this to the point of like 7.2% of our diesel pool now, we're actually using a lot more than we were in 1999, and we're running above the 10-year average for demand. So while it's kind of a victim of its own success, while you have all this penetration, increased blending of renewable diesel, and increased blending of biodiesel, at the same time, that makes the demand for petroleum diesel go down, which brings prices down with it. And the price of diesel it is by far the number one factor that underpins the profitability for biodiesel producers and for renewable diesel producers. So in a way, they're creating a weak environment for the NYMEX ULSD, the ultra low sulfur diesel that underpins their economics. So, I mean, at this point in the game, with the amount of geopolitical risk that there is out there, the amount of disruption to product, I thought we'd have a lot more premium baked into diesel than we're seeing right now. But demand has been flagging. But from a macro econ standpoint, when you look at it, technically, we're actually consuming a lot more. And here at AEGIS, I don't know if we coined the term, but we use it a lot. It's not an energy transition, it's an energy addition. Like we're using more energy from more sources. And so it's important, like a lot of the traditional data that everyone lives and dies on, we've been using for so long. You need to start, renewables are so important that you need to start, building that into your models and start looking at a more holistic picture, because you might lose the whole story that's going on. Yeah, so the short answer to that is I think it is almost entirely contingent, and not entirely contingent, but it's very heavily contingent on diesel picking back up. And it's tough because it's it's in an industry where it is increasingly becoming more efficient, and then we now have a surprising amount of international spare refining capacity coming online. Dangote is proceeding better than anticipated down over in Nigeria, and then you got Dos Bocas in Mexico, and so we're not necessarily in the lack of spare refining capacity plus Ukraine war extremes that we saw in the last 2 years, but we're more at basically a normalization of the diesel market. So, yeah, it's definitely a tighter margin environment for biodiesel producers, but there's ways around that, and it could be a whole other hour of conversation on that subject.
We could go on all day about all of this.
Complex.
Somebody had mentioned something that we hadn't really talked about a little bit. Heating oil, we're kind of focused in on transportation, and we really are thinking of on-road, but I'm seeing, and I'm sure you guys are too, that there's more marine usage. There's more, the railroads are looking at it more. Just seems like, not all of a sudden, but pretty recently, there seems like more interest in these other transportation. And I know, Xander, you were just saying that, we're actually using more of it than we think of the renewable diesel and bio.
I mean, if I was the biodiesel industry, I would be pushing really hard to get into the marine sector, because that's always going to be, the last to decarbonize and some of the dirtiest fuels. I mean, ports have, it's been shown consistently have some of the highest cancer rates. So any way to clean that sector up, beyond scrubbers and, adding urea to some of the diesel engines. I mean, yeah, it would be a great place to make this surplus volume disappear, or put it to good use, rather.
Yeah, and I know recently, and I don't know if David, you have any updates on this, but right now, as it stands, you have to retire the RIN if it goes outside U.S. waters. But I think just recently somebody had proposed a change to that so that we weren't having to retire if they leave U.S. waters. I don't know if you've heard anything about that, or if there's any update on that.
Yeah, I've seen that. I think that was to Xander's point that there is a push by the biodiesel industry to get into the marine bucket, and that bill you're talking about, Ginger, I think would allow them to generate a RIN and not have to retire it
Right.
when it goes to marine use. I don't think that's likely to happen though in the near future, right? I mean, I think that's just a low probability policy change.
In an election year, very, very contested election, so much hinging on that. I'd agree. It's unlikely that stuff's going to get tacked on, but certainly worth the push for those folks.
Xander, somebody had the same question that I asked you about what's an RDD4 versus a D4 on your chart. I'll pull it back up again.
Yeah, it's quite simple. It's, renewable diesel producer is going to earn 1.7 D4 RINs for every gallon they produce. Some of them are more like 1.6. SAF makes 1.6. So essentially, they're going to get 1.7 D4 RIN value. So it's just D4 times 1.7 for the given day. And as you can see, it's generally, it's going to be either side of flat, but if you look at it from March to the present, it averages out to flat. So that's quite the correlation. And I think people have been waiting for some sort of normalization. I think, but the problem was they were looking at just purely the D4 versus the BOHO, and that's probably never going to correlate ever again the way it did, a couple decades ago, or like a decade ago.
Well, as we said, we could probably keep going for like days about all of this, but we can't. So, but maybe we can do another one, do another webinar, or fireside chat. So here is most of our information. I don't have Xander's on here, but I'm sure, I think we had some questions that Xander can answer directly, or they can contact directly that came up in the Q&A.
There's probably not many Xanders on LinkedIn. That's my guess. So you should be able to find
Yeah,
me.
you're right. Or Gingers. So like some of the resources and links that we talked about, that I talked about at the beginning, like the HPIP and trying to find out what your state incentives might be. Our website, the NATSO Outfuels website, has some tools on there that you can look at for blending, for that alternative data fuel center to look at that. And here's David's email if you have any questions about the blender's tax credit. Obviously, NATSO's Day on the Hill is coming up in about almost a week from now. So that's a website to look at that and see what's going on there. And then I saw there were some questions in the Q&A about the some of the research. And I think if you can contact Tiffany, she should be able to connect you with what you're looking for there. On the clean fuels production credit, I don't know if David, somebody had asked, you could point them to where they could find more information on the labor end of that, or somebody has that information.
I mean, unless you are producing fuel, that's not a material concern for you as a buyer of the fuel. What I think Xander was referring to is that the producer from whom you buy your biofuel, in order for them to access all of the value of that credit, they need to be implementing apprenticeship and wage requirements. My impression is that generally those are not as onerous as was initially feared. I think most biofuel plants by the beginning of 25 will be in compliance with them, but I may be wrong about that. I just don't think I am. Is that wrong, Xander? I was hoping you would correct me or reaffirm me.
No, I know that it was a producer that asked. So,
Oh, got it. Fair enough.
yeah, it's in the Inflation Reduction Act.
Right.
It's 179 pages of law that, but Control F is your friend. Just wages, apprenticeship, key terms. Yeah, there was some additional questions about, the recent SAF Greek guidance. I don't know how much overtime here we can go to answer questions, but just the long story short is that, what they came out with was, some advantage scores for soy and corn, opening the door for a possible alcohol to jet. Now, a lot of these are pilot programs, no pun intended for the aviation fuel. But, you know, the danger here is that this is going to set the ground, this is likely going to set the groundwork for the GREET that's used for 45Z. And what underpinned all this was climate smart agriculture, CSA. That's going to be like a really big acronym now. 3 practices, you have to meet all 3, which is no tilling, crop cover, cover crops, and enhanced efficiency fertilizer. You have to use all 3. Now, there's certain parts of the country where you cannot do cover crops. And so that kind of disadvantages and also creates pockets where this isn't going to be possible. So I think, you know, a lot of, you know, it's too early to tell on a lot of stuff because you have people who are fuel experts, people who are, you know, regulatory and you know, steeped in the regulatory aspect of this, but you also need to get in touch with people on the ag side to figure out how much of this stuff actually qualifies. And so analysts and consultants are in the middle of trying to figure that out right now, because if they get this wrong for 45Z, there's really not going to be there's a potential that a lot of this might not qualify, but I've seen arguments to both sides, so I'm trying to make sense of it myself right now.
Well, we are recording. We have recorded this fireside chat today, so we should be able to make that available probably next week, or we'll let you know when we have a copy of that. But thanks to all of you that are attended and all of you that helped answer some of the questions about what's going on legislatively. Obviously get involved in knowing what's going on with the blender's tax credit. And please contact us with any other questions that may come up after we say goodbye today. But thank you very much to all of you for joining us. We appreciate you.
Thanks, guys.
Thanks, everyone. Have a nice day.